Hello everyone, I'm Kenshin. Welcome to History Talks. Please subscribe, like, comment, and share, and don't forget to turn on the notification bell. Thank you. Today's historical discussion is about the century's business scandal, the Enron scandal. Do you still remember when virtual currencies were speculated to be the next Dutch tulip bubble? On November 11, 2022, in the United States, a bigger bombshell exploded. FTX, the world's second-largest cryptocurrency exchange, declared bankruptcy due to a funding shortfall of up to $8 billion. But it doesn't stop there. Blockchain risk firm Elliptic revealed that digital assets worth up to $473 million disappeared from FTX's books and were converted into Ether. In Taiwan alone, at least 6,000 people were affected, with losses exceeding $100 million. Some investors even claimed FTX claimed to have regulatory licenses and GAAP certification, appearing to be legitimate, but secretly misappropriated client funds. This goes beyond mere bankruptcy. Many media outlets liken this event to a replay of the Lehman Brothers collapse, but I believe it is more akin to the Enron scandal that shocked Wall Street in 2001. Let's rewind to 1985 when Kenneth Lay merged Houston Natural Gas Company and Internorth to form Enron. In the early 1990s, he pioneered electricity market trading and later lobbied Congress to deregulate natural gas trading, enabling companies like Enron to sell natural gas at higher prices, significantly boosting profits. Despite calls for price regulation, Enron vehemently opposed anything that threatened its profits. Do you know how lucrative their revenue was? In 1992 alone, their pre-tax revenue from natural gas contracts reached a staggering $122 million, making them the largest natural gas seller in North America and the second largest source of income for the company. During their expansion, Enron pursued a diversified investment strategy, involving natural gas pipelines, power plants, pulp, paper production, water facilities, and Internet services, all to maximize profits. However, the company's stock only rose by 311% from 1990 to 1998, just slightly higher than the average of the S&P 500 index. Yet in 1999 alone, it surged by 56%, reaching an 87% increase in 2000. Compared to the S&P index, which grew by 20% in 1999 and dropped by 10% in 2000, this was significant. By December 31, 2000, Enron's stock reached $83.13 per share, with a market value of $60 billion, 70 times its revenue and 6 times its book value. It was even named the most innovative company in America by Fortune magazine. However, as they say, where there's smoke, there's fire, and this case was no exception. When Jeffrey Skilling joined the company's management team, their mission was clear: to use accounting loopholes, special-purpose entities, and poor accounting reports to conceal billions of dollars in debt from failed contracts and projects. Chief Financial Officer Andrew Fastow and senior staff misled Enron's board and audit committee on high-risk accounting practices, pressured the prestigious accounting firm Arthur Andersen to overlook these issues, and used complex financial reporting systems to deceive shareholders and analysts. By manipulating earnings and altering balance sheets, they portrayed strong performance. For example, between 1996 and 2000, revenue increased more than 750%, from $13.3 billion in 1996 to $100.8 billion in 2000, with a staggering 65% annual growth rate, unprecedented in the industry. In the first 9 months of 2001, Enron reported revenue of $138.7 billion, ranking 6th in the Fortune Global 500. Enron's issues were numerous. To conceal poor financials, in 1999, Fastow established 2 limited partnerships. Their purpose was simple: to buy Enron's underperforming stocks and shares to improve financial statements. In other words, Enron used special-purpose entities as shell companies, even naming one after the velociraptors in Jurassic Park. Enron transferred over $1.2 billion in assets, including millions of shares of Enron common stock, the purchase of long-term options on millions of shares, and $15 billion in Enron's payable notes. In simple terms, they manipulated debt through buying and selling, aiming to beautify financial statements, with the total value of derivative contracts reaching $2.1 billion. However, these contract values plummeted, leading to a $1.1 billion decrease in portfolio value within a year, leaving only $1 billion in value. Let's fast forward to February 2001 when Enron's CFO Rick Corsi told the budget manager, "From an accounting perspective, this will be our easiest year. We've already pocketed the 2001 revenue." However, on March 5, Fortune magazine published Bethany McLean's article, "Is Enron Overpriced?" questioning how Enron maintained a P/E ratio of 55, deeming it abnormal. When analysts and investors weren't clear on how Enron earned its revenue, one analyst suggested she reviewed the company's 10-K report. There, she found strange transactions, unstable cash flows, and massive debt, becoming the first journalist to notice the company's situation. Even before publishing the article, she called Enron's top management to discuss her findings but was labeled unethical by Skilling for improperly scrutinizing the company, which is ironic as understanding a company's operations is investors' responsibility. Furthermore, CFO Fasto's actions confirmed this inference. He told two Fortune journalists that Enron wouldn't disclose revenue details because the company had over 1,200 trading books for various commodities, stating, "Don't want anyone to know what's in those books. We don't want to tell anyone where we're making money." However, things weren't that simple. On April 17, 2001, during a conference call, Skilling attacked Wall Street analyst Richard Grubman, questioning Enron's unusual accounting practices and complained that Enron was the only company not disclosing balance sheets and income statements together. Skilling's response was, "Well, thank you very much. We appreciate that. Asshole." Although it became an internal joke among Enron employees, it alarmed and surprised the media and the public. By mid-July 2001, Enron reported $50.1 billion in revenue, nearly triple the year to date, far exceeding all Wall Street analysts' expectations of earnings per share of 3 cents. As time progressed, Enron began to face many alarming facts, namely, severe losses in many projects and the company itself. On August 14, Skilling announced his resignation from the CEO position after just 6 months, admitting the plummeting stock price of Enron as a significant reason for his departure. Economist Paul Krugman, notorious for his title as the most hated economist globally and a Nobel laureate in economics, remarked in his New York Times column that Enron's downfall was a case study of the consequences of deregulation and the commodification of energy, once again proving his cynicism correct. By late August 2001, despite the temporary diversion of public attention due to the 9/11 events, Enron's stock price continued to decline. However, the truth cannot be hidden for long. On October 16, Enron announced the necessity to restate financial statements from 1997 to 2000 to rectify accounting irregularities. The restatement resulted in a reduction of revenue by up to $613 million and an increase in liabilities by $628 million by the end of 2000. The consequences of these events were dire. Moody's and Fitch, two of the three major credit rating agencies, planned to review Enron's ratings for downgrade. This action would force Enron to issue millions of shares to repay secured loans, further diminishing the value of existing stocks, especially when, on October 30, Moody's downgraded Enron's credit rating from Bar 1 to Bar 2, just 2 notches above junk status, heralding disaster. On November 28, 2001, two of Enron's worst outcomes materialized. Dinergy unilaterally withdrew its acquisition proposal, leading to Enron's credit rating being downgraded to junk status. By the end of that day's trading, the stock price had plummeted to 61 cents per share. A commentator succinctly remarked, "Enron is now a shorthand for a perfect financial storm. The situation is dire." Enron's estimated total liabilities, including unpaid debts and secured loans, amount to around $23 billion. Citigroup and JP Morgan Chase are expected to suffer significant losses due to Enron's bankruptcy. Additionally, since many major assets have been pledged as collateral for loans, there are doubts whether unsecured creditors and shareholders will receive anything after Enron's bankruptcy proceedings conclude. Enron's European subsidiary filed for bankruptcy on November 30, 2001, and sought protection under Chapter 11 of the bankruptcy law 2 days later. This marked the largest bankruptcy event in U.S. history at the time, only to be surpassed by the WorldCom bankruptcy the following year, resulting in 4,000 job losses. On the day of the bankruptcy filing, employees were instructed to gather their belongings and vacate the building within 30 minutes. Nearly 62% of the 15,000 employees had their savings plans tied to Enron stock, which, despite being priced at $83 per share in early 2001, became nearly worthless. On January 17, 2002, Enron terminated its auditing firm, Arthur Andersen, citing accounting advice and document destruction. However, Andersen disputed this, claiming its relationship with Enron had ended upon the company's bankruptcy. Investors suffered greatly. Enron shareholders lost $74 billion in the 4 years leading up to the bankruptcy, with $40 to $45 billion attributed to fraud. With Enron owing creditors nearly $67 billion, employees and shareholders received limited assistance beyond severance pay. In May 2004, over 20,000 former Enron employees won a lawsuit, receiving $85 million to compensate for $2 billion in pension losses. As per the settlement agreement, each employee received $3,100. How bad is the situation? It's estimated that Enron, including unpaid debts and secured loans, has liabilities of about $23 billion. Particularly, Citigroup and JP Morgan Chase are expected to suffer significant losses due to Enron's bankruptcy. Moreover, as many major assets have been pledged as collateral for loans, some doubt whether unsecured creditors and shareholders will receive anything after Enron's bankruptcy proceedings end. Enron's European subsidiary filed for bankruptcy on November 30, 2001, and sought protection under Chapter 11 of the bankruptcy law 2 days later. This marked the largest bankruptcy event in U.S. history at the time, only to be surpassed by the WorldCom bankruptcy the following year. It resulted in 4,000 job losses. On the day of the bankruptcy filing, employees were instructed to gather their belongings and vacate the building within 30 minutes. At that time, nearly 62% of the 15,000 employees' savings plans relied on Enron stock, which was worth almost nothing despite being priced at $83 per share in early 2001. On January 17, 2002, Enron terminated its auditing firm, Arthur Andersen, citing accounting advice and document destruction. However, Andersen disputed this, claiming its relationship with Enron had ended upon the company's bankruptcy. As for the investors' losses, Enron shareholders lost $74 billion in the 4 years leading up to bankruptcy, with $40 to $45 billion attributed to fraud. With Enron owing creditors nearly $67 billion, employees and shareholders received limited assistance beyond severance pay. In May 2004, over 20,000 former Enron employees won a lawsuit, receiving $85 million to compensate for $2 billion in pension losses. According to the settlement agreement, each employee received $3,100. Due to the Enron scandal, the Sarbanes-Oxley Act was enacted, which is the most significant securities legislation since 1930, improving U.S. securities laws. As for the documentary, The Smartest Guys in the Room, released in the United States in 2005, it allows us to understand what Enron did to conceal the whole affair through interviews, news, and excerpts from congressional hearings. Returning to the present, the aftermath of FTX's bankruptcy is far-reaching. The U.S. House Financial Services Committee announced on November 16, 2022, that it plans to hold hearings in December to investigate. Celebrities endorsing FTX are set to appear in court, including MLB Angels two-way star Shohei Ohtani, NBA Golden State Warriors top player Stephen Curry, NFL legendary quarterback Tom Brady, former NBA star Shaquille O'Neal, and other sports and entertainment figures. This lawsuit seeks unspecified damages, alleging that FTX has caused over $11 billion in damages to U.S. consumers, and seeks to hold the defendants accountable for billions of dollars in losses suffered by the plaintiffs, further asserting that FTX's fraud scheme aims to exploit unsuspecting investors nationwide. FTX's new CEO, John Ray, criticized the operations of the failed cryptocurrency exchange, stating, "In my career, I have never seen a company operate so thoroughly poorly and lack trustworthy financial information." He even mentioned overseeing the liquidation process for years after the collapse of the energy company Enron in 2001. Due to FTX customer accounts not being protected by the Federal Deposit Insurance Corporation, the U.S. government won't intervene as it does with traditional bank closures, leaving customers reliant on the bankruptcy process. With little precedent on how much they'll recover, customers have relatively lower priority unsecured claims. In 2022, Bitcoin plummeted over 10%, reaching its lowest level since November 2020. Online trading platform Robinhood's stock value also dropped by over 19%, and cryptocurrency exchange Coinbase fell by 10%. This prompted senior stock analyst Dan Ives to describe it as a black swan event, instilling more fear in the cryptocurrency realm. The cold winter of 2022 brought further apprehension for cryptocurrencies. Regarding the recent surge in virtual currencies, whether it's genuine or speculative remains debated. Share your opinion in the comments.